Welcome back to another explainer. Grab your investor hats because today we are unpacking a totally fascinating case study of a company right in the middle of a massive identity shift. We're looking at the 2026 financial results for Duty Free International Limited. Now, on the surface, these numbers present a total mystery, one that would honestly make any retail investor do a double take. Okay, let's dive into this. Picture this scenario. It's kind of the ultimate financial paradox. You always want to see a company bringing in more money, right? But when a massive 37% surge in sales is met with a 59% absolute collapse in bottom line profits, well, we really have to stop and ask ourselves what in the world is going on under the hood. To solve this mystery together, here's our roadmap. First, the revenue profit paradox. Then, unpacking the profit drop, followed by the new automotive engine. After that, we'll look at the duty-free sales decline, dive into cash and future trends, and finally, wrap it all up with our final investor takeaways. All right, let's kick things off with Section 1, the revenue profit paradox. And this brilliantly illustrates the stark contrast we are dealing with here. Look at 2025. You've got revenue sitting at 155.1 million Malaysian ringgit. Fast forward to 2026, and boom, it shoots all the way up to 212.6 million. Incredible, right? But wait, despite that top-line growth, the actual profit completely fell off a cliff, dropping from a super healthy 53.6 million in 2025 to just 22.2 million in 2026. Usually, growing sales mean growing profits. So what exactly went wrong? Let's peel back the next layer in Section 2, unpacking the profit drop. Okay, so it all comes down to this one gigantic number, over 69.6 million Malaysian ringgit. Now, when we dig into the 2025 financial statements, we find this massive amount listed simply as compensation from compulsory land acquisition. To put that in plain English, the government actually forced the company to sell some of its land, and they paid them nearly 70 million ringgit for it. This was a completely one-time event. It's basically like finding a winning lottery ticket. That payout heavily skewed the 2025 data, making the profits for that year look artificially high. So, because that lucky windfall didn't magically repeat itself in 2026, the current profits naturally just looked way lower by comparison. And without that massive land payout masking things, the normal day-to-day operating costs set a much more realistic baseline for 2026. And those costs, they went up a lot. Employee benefits jumped 23%, utilities shot up by a whopping 86%, and depreciation on their physical assets increased by 81%. Basically, the everyday cost of simply keeping the lights on and paying the staff got significantly more expensive. Moving on to Section 3, the new automotive engine. Now, what's really interesting about this is figuring out where that initial 37% revenue surge actually came from. It came from a massive pivot. The company stepped way outside its traditional comfort zone and actually acquired an auto parts manufacturer. And that acquisition quickly claimed a huge chunk of the revenue pie. Out of the 212.6 million in total revenue, 72.5 million ringgit came entirely from this brand new segment. Meanwhile, the legacy duty-free business brought in 137.5 million, and it was just a tiny slice from investment holdings. So this new automotive engine, it is completely responsible for that entire 37% surge in total revenue. But hey, as an investor, you don't just care about raw sales, right? You need to know if this shiny new venture actually makes any money. And the great news here is, absolutely, it does. The new automotive segment generated over 10.4 million Malaysian ringgit in pure profit during its very first year under the duty-free international umbrella. That means it's not just driving sales, it is highly profitable right out of the gate. Which brings us to Section 4, duty-free sales decline. So the crucial point is, when a company buys a shiny new toy, we have to double-check that the original foundation isn't crumbling underneath them. And honestly, the core legacy business is definitely struggling. Duty-free revenue dropped from 151.9 million down to 137.5 million ringgit. But even more alarmingly, the profit from this specific segment was literally cut in half, plunging from 61.5 million down to just 30.5 million. Honestly, without that auto parts acquisition, Duty Free International would be staring down a really significant contraction in both sales and profits. Let's look at the balance sheet in Section 5, cash and future trends. Because buying a massive manufacturing company, yeah, that is not cheap. This huge figure, over 143.5 million Malaysian ringgit, that is the net cash outflow the company used to actually purchase the new automotive subsidiary. They really had to reach deep into their pockets to make this big diversification play happen. And as a result, the company's cash pile has taken a major hit. Back in 2025, they had a really comfortable cash cushion of over 230 million ringgit. Today, that balance sits at 107.3 million. Now, don't get me wrong, that is still a significant amount of money, but their safety net has essentially been cut in half. This represents a highly aggressive investment strategy to diversify away from a duty-free market that is very clearly losing its steam.
Let's wrap this all up in Section 6, Final Investor Takeaways.
So what's the bottom line? We are witnessing a complete transformation here. Duty-Free International is no longer just a duty-free retailer. It's actively evolving into a diversified manufacturing entity. The legacy business is undeniably contracting. We're seeing shrinking sales and shrinking profits there. However, the new automotive division is stepping right up as the primary engine for both top-line growth and fresh profits. Management took a very calculated risk. They spent a huge chunk of their cash reserves to literally buy their way into a brand new industry, all to offset the weakness in their core business. And that leaves us with this final, genuinely provocative question for anyone tracking this company. The transition is underway, for sure. But is it happening fast enough? Will the new automotive engine accelerate fast enough to outpace the slowdown in duty-free sales? Only the coming quarters will tell if this bold pivot truly pays off in the long run. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.